Hello, everyone. Welcome back to Money Café America, where we slow money down until it makes sense.
Hello, I am Ethan.
And I am Maya. Today we are looking at those three little numbers that cause quiet panic.
I feel that panic deeply. You get an email saying your score changed.
Right. And your heart immediately drops into your stomach.
Exactly. You log into your bank app feeling terrified.
You hold your breath before the dashboard page finally loads.
You see your score dropped 12 points, and you have absolutely no idea why.
You start frantically wondering if you missed a payment.
Or if buying gas on the wrong day somehow ruined everything.
That is such a common and exhausting fear.
It feels like a secret test. You do not even know the grading rubric.
Avoiding your score does not make you bad with money. It is just stressful.
It really is. I just want to know what actually matters.
We can clear that up. We are sharing general education today, not personal financial advice.
That works for me. A general map would be incredibly helpful right now.
The rules of credit can feel completely backwards sometimes.
They really do. My friend paid off her car loan last month.
That is a huge accomplishment for her budget.
It was. But then her credit score actually went down.
Oof. That stings so much when you are trying to be responsible.
How are you supposed to win a game like that?
It feels totally unfair when you do not know the mechanics behind it.
It makes people want to just stop trying altogether.
I hear that a lot. But the system is mostly just a math formula.
It feels much more like a harsh judge to me.
That makes sense. A low score can affect your rent or car payments.
I need to know which mistakes actually hurt my progress.
And which ones are just old myths keeping you up at night?
Because there are so many weird myths out there.
So many. Like the idea that carrying a balance builds your credit.
Wait, carrying a balance month to month does not help?
It absolutely does not. That is one of the biggest and most expensive traps.
Wow, I have definitely heard people swear by that rule.
By the end of this episode, you will have a clear checklist.
A checklist sounds very manageable.
We will cover 3 common credit mistakes people make without realizing it.
And we will learn how to actually fix them?
Yes. We will look at practical steps to protect your score moving forward.
That takes a lot of the heavy pressure off my shoulders.
We will also introduce a few simple money terms as we go.
As long as they are in plain English.
Always plain English. What is the most confusing credit advice you have ever heard?
I would love to hear what other people have been told.
You can drop that confusing advice in the comments for us.
I am ready to finally figure out what is true.
The core problem is how people view their score. They treat it like a financial test.
Right. If that number drops, it feels like you are failing at being a functional adult.
But the formula does not know your bank balance. It only tracks borrowed money.
So it is not actually grading my true wealth or my savings at all?
Not at all. Think of your credit score like a simple trust thermometer for lenders.
A trust thermometer? That is an interesting way to picture it.
Yes. It measures one specific temperature. How much does a bank trust you with borrowed money today?
Aha! That takes the personal judgment completely out of it.
Exactly. The plain rule is simple. Your score measures borrowing risk, not your human worth.
So a sudden drop just means the thermometer picked up a temporary change in your risk.
That is right. It is a shifting metric. You are not bad for a low reading.
That honestly removes so much of the heavy shame around opening the banking app.
If that trust thermometer idea helps, save this episode for the next time your score drops.
Keep it nearby for the next time a scary credit alert email ruins your day.
Exactly. Because sudden panic usually pushes people into making the most common credit mistakes.
Like what? What is the biggest trap people fall into when fixing their score quickly?
The biggest trap is closing your oldest credit card. People do this after they finally pay the balance.
Wait, you are not supposed to close the account after you clear the balance completely?
No. Closing that old account actually hurts your score. It shrinks your total history of safe borrowing.
Wow, I have definitely done that. I genuinely thought I was cleaning up my financial life.
People often wait until they feel motivated. Then they cancel old cards to feel more organized.
You might be staring at an old store card right now. You think closing it is responsible?
But that old card acts like a long, stable reference letter on your trust thermometer.
Oh, so when I closed my oldest account, I basically shredded my longest positive reference letter?
Yes, the better way is to leave your oldest free accounts open. Keep a zero balance.
You just let the card sit there completely empty in the background?
Exactly. Let the thermometer keep reading that long history of stability. You never even have to carry it.
But what if someone is afraid of being tempted to use that old plastic card again?
That is a very real concern. You can literally cut the plastic card in half with scissors.
So the account stays open on your credit report, but you physically cannot swipe the card?
That is the perfect balance. You protect your long credit history. You also protect your daily spending habits.
That is brilliant. It feels so much better than stressing over some mysterious financial algorithm.
You just have to know which levers actually move the needle. You do not need to guess.
Leaving an empty account open sounds like such a small, incredibly easy win for my score.
It really is. Understanding that one rule prevents so much unnecessary damage to your overall profile.
I always thought I had to keep proving my worth by opening and closing things constantly.
That constant action makes the thermometer nervous. Lenders prefer boring stability over rapid changes.
Boring stability sounds incredibly relaxing to me right now. I am tired of the constant credit anxiety.
We can definitely aim for boring. It is the absolute best way to manage your credit health.
I really like that plan. This whole system actually feels a lot more manageable now.
So the plain rule to remember is that boring stability protects your score.
Lenders want to see a calm history, not sudden movements.
Exactly. But everyday life is rarely boring or perfectly stable.
Life is full of surprise expenses and weird timing gaps.
That is when people usually accidentally hurt their trust thermometer.
Because they react to the stress instead of playing the formula.
Yes. Let us look at 3 real situations where this happens.
I am definitely ready for the first scenario.
Imagine your car breaks down during a really busy work week.
Oh, that is the worst feeling.
You put a $2,000 repair on your only credit card.
Because you have to get to work. You have no choice.
Right. Your card has a $3,000 limit.
So you used most of your available credit in one single day.
Yes. And your plan is to pay it off over 4 months.
That sounds like a responsible plan to handle an emergency.
It is responsible for your life. But the thermometer hates it.
Wait. Why does the credit formula hate a responsible payment plan?
Because you are suddenly using almost all of your available credit.
Oh, so it looks like I am maxing out my card?
Yes. To the formula, high usage looks like sudden financial panic.
Even if I am just fixing my car so I can keep working?
The math formula cannot see your broken radiator. It only sees risk.
That feels incredibly unfair when you are just trying to survive.
It does. Using a high percentage of your limit drops your score fast.
So, what is the first instinct most people have when that happens?
They assume paying the minimum on time will keep their score high.
But the high balance itself is what is dragging the number down.
Exactly. The practical step here is managing your credit utilization.
How do you do that if you already had to swipe the card?
You try to keep your balance below 30% of your limit.
But what if the emergency costs more than 30%?
That is the limitation here. Sometimes you just have to take the hit.
Because fixing the car is more important than a temporary credit dip.
Yes. Your score will naturally bounce back as you pay the balance down.
So I do not need to panic if an emergency ruins my utilization.
Exactly. You just focus on clearing the debt steadily over time.
That makes a lot of sense. What is the second scenario?
Imagine you are standing at the checkout line, buying new clothes.
And the cashier offers me a big discount to open a store card.
Yes. You fill out the quick application right there at the register.
I have done that. The discount usually feels totally worth it.
Then, 2 weeks later, you apply for a new travel rewards card online.
Because you have a trip coming up and want to earn the points.
Right. But your first instinct is that shopping for credit is harmless.
As long as I am approved, it shows I am trustworthy, right?
Actually, applying for multiple things quickly makes you look desperate.
Desperate? I was just trying to get a discount on winter sweaters.
Every time you apply, the lender checks your official credit report.
And that official check leaves a permanent mark on my record?
Yes, it is called a hard inquiry. Too many inquiries scare the formula.
Because it looks like I am suddenly begging everyone for borrowed money.
Exactly. The thermometer sees rapid requests and assumes you are in trouble.
Even though I am just hunting for rewards, points, and store discounts.
Yes. The practical step is to space out your applications.
How far apart should I space them out to be totally safe?
Try to wait at least 6 months between opening new accounts.
That means saying no to the store cashier most of the time.
It does, but there is a realistic caution to this rule too.
What is the caution? I want to make sure I understand.
Do not obsess over one single inquiry. One check barely hurts.
It is the rapid stacking of applications that causes the real damage.
Yes. Just be intentional when you finally ask for new credit.
Okay, space out the applications. What is the third scenario?
This one causes the most anxiety. Imagine a very chaotic month.
Maybe you are moving apartments or dealing with a bad cold.
You are exhausted. You completely forget your credit card due date.
Oh no. And you realize it 3 days after the bill was due.
Yes. What is your immediate reaction when you see that late notice?
Absolute panic. I assume my credit score is completely ruined for years.
That is everyone's first instinct. People think a one-day delay destroys everything.
Does it not? I always thought late payments were the worst possible mistake.
They are bad, but the credit bureaus do not track individual days.
Wait, what does that mean? How do they track it then?
A late payment does not hit your credit report until it is 30 days late.
Are you serious? So being 3 days late does not show up on my score?
That is correct. Your bank will absolutely charge you a late fee.
They will probably charge me interest on the carried balance too.
Yes, you pay a financial penalty to the bank immediately.
But my official trust thermometer stays completely safe from the mistake?
As long as you pay it before that 30-day mark finally hits.
That is a massive relief. I have definitely lost sleep over 2 days.
So many people do. The system gives you a brief grace period for your score.
What is the practical step to prevent that 30-day disaster entirely?
Set up an automatic payment for just the minimum amount due.
Even if I usually pay the full balance manually every single month?
Yes. The automatic minimum acts as a safety net if life gets chaotic.
So if I forget, the minimum pays automatically and my score is protected.
Exactly. Then you can log in later and pay the rest of the balance.
What is the limitation with that specific strategy?
You have to make sure your checking account has enough to cover that minimum.
Right, or else you end up with an overdraft fee from your bank.
Exactly. But it is the strongest shield for your long-term credit score.
That is incredibly useful. The penalty is financial, not a permanent credit scar.
These three traps catch people because the rules are never explained clearly.
We are just expected to guess how the formula interprets our busy lives.
Yes. And guessing usually leads to expensive or highly stressful mistakes.
We can stop guessing now. The rules actually make a weird kind of sense.
They do. I want to give everyone a concrete mini action to try today.
Something that takes less than 24 hours to actually do?
It takes 5 minutes. Log into your primary credit card app today.
Okay, what am I looking for once the dashboard finally loads?
Find the automatic payment settings. Turn on the minimum payment autopay feature.
Just the minimum, so the safety net is officially in place.
Exactly. You protect your score from a chaotic month with one single click.
That feels like a tiny piece of armor against real-life stress.
It really is. Small, proactive systems prevent big financial panic later.
I feel a little more prepared to handle these weird credit rules now.
We covered some common traps today. We talked about high balances and rapid applications.
Knowing the formula just looks for stability really helps.
Now, let us analyze a slightly different situation.
Oh boy, I will try my best. What is the new scenario?
Your cousin is planning to move into a new apartment next year.
Okay, so she needs a decent score to get approved by the landlord.
Right. She decides to pay off her oldest credit card and close the account completely. Then she applies for 3 new cards to increase her total limit.
That actually sounds somewhat logical.
Tell me why you think it sounds logical.
Paying off debt is a good move. Getting a higher total limit means using a smaller percentage.
You are right about the first part. Paying debt off is a great instinct.
But I am guessing the second part is a trap?
It is. You spotted the exact issue. While a higher limit is nice, the method causes a problem.
Because applying for 3 cards at once makes her look desperate right before she meets the landlord.
Yes. And closing her oldest account shrinks her long history of being a reliable borrower.
Oh, so she is erasing her best reference letter while simultaneously asking 3 new places for money.
Exactly. The landlord will pull her report and see a sudden burst of panicked activity.
That makes perfect sense when you say it out loud. It looks chaotic instead of stable.
You analyze that beautifully. Let us introduce our money terms for today.
I am ready. As long as we keep the definitions simple and skip the heavy textbook jargon.
We will absolutely keep them simple. Our first term is credit utilization ratio.
Credit utilization ratio. That sounds like a fancy way to say how much card limit I use.
That is the perfect plain definition. It is simply the percentage of your limit you are borrowing.
So if I have a card with a $1,000 limit, what is the example?
If you buy groceries for $300, your ratio is 30%.
That seems easy enough. Why does that specific percentage matter so much to the formula?
A high ratio signals that you are relying too heavily on borrowed money to survive.
It makes the trust thermometer spike. It looks like my own cash is running out.
Exactly. How would you explain that concept to a friend who is confused by the jargon?
It is like eating a pie. Lenders do not mind a small slice, but eating the whole pie makes them nervous.
I love the pie metaphor. It paints a very clear picture of the risk.
It definitely makes the math feel a lot less intimidating. What is the second term?
The second term is hard inquiry.
Hard inquiry. I have definitely seen that phrase on my banking app before.
A plain definition is that a lender officially checked your report because you asked for money.
So checking my own score on my phone does not count as a hard inquiry?
No. Checking your own score is a soft inquiry. It does not hurt you at all.
Okay, so a hard inquiry happens when I apply for that retail card at the register?
Yes. That is a perfect everyday example. The cashier submits your application, and a hard inquiry is instantly recorded.
Why does it matter if the inquiry stays on my official record?
It stays visible for 2 years. A single inquiry is fine, but several rapid inquiries look like a warning sign.
It looks like you are suddenly begging for help from multiple banks all at once.
Exactly. Now translate hard inquiry into your own words.
It is a permanent log showing I actively asked for a loan. It is not just me browsing my own data.
That is perfectly stated.
Understanding the mechanics definitely reduces the fear.
We have one more term. Our third term today is credit history age.
Credit history age. That sounds pretty straightforward.
It is. The plain definition is the average length of time your credit accounts have been open.
So my oldest card and my newest card get averaged together?
Exactly. Imagine having one old card and adding a new car loan. Your overall average age drops.
Why does the formula care so much about the average age of everything?
An older average proves you can manage borrowed money responsibly through multiple years of real life.
Lenders want to see a long track record of boring, reliable payments.
Yes. They trust a 10-year track record, much more than 6 months of perfect behavior.
That is why closing my oldest card was such a huge mistake back then.
Exactly. You lowered your average age instantly. How would you summarize this term?
It is the length of my financial reference letter. I should never intentionally shred the oldest pages.
That is a brilliant translation. You now have the vocabulary to read your own score report.
Knowing these 3 terms actually makes me feel so much less vulnerable.
Let us try one more scenario to test your new knowledge.
I am ready for the test. Lay the new scenario on me.
You just got a nice raise at work. You want to lower your utilization ratio.
That is a great problem. I want my ratio as low as possible.
You realize you can ask your credit card company to increase your total borrowing limit.
Because if my limit goes up, my normal grocery spending becomes a smaller percentage.
Exactly. That is a very smart strategy to improve your overall profile.
So my plan is to call all 4 of my credit card companies this afternoon.
Let me stop you right there before you make the calls.
Wait, did I just walk right into another invisible credit trap?
You did. Asking for a limit increase is good, but asking 4 banks suddenly is dangerous.
Oh, because they might all do a hard inquiry on my report at the same time?
Yes. Some banks only do a soft check, but others do a full hard pull.
So asking all of them at once makes me look incredibly desperate again.
It absolutely does. The trust thermometer spikes because of those rapid requests.
It looks like I suddenly need a ton of money to survive my week.
Exactly. Lenders get nervous when you suddenly want access to thousands of new dollars.
Let me try that scenario again. I will call just my oldest, most trusted card first.
That is the right move. How do you handle the representative on the phone?
I will ask them if a limit increase requires a hard inquiry today.
Perfect. You protected your score while still trying to improve your utilization ratio.
If they say it requires a hard pull, I can just politely decline and hang up.
You handled that beautifully. You took control instead of just guessing the rules.
It actually feels empowering to know what questions to ask the bank.
How would you use everything we talked about today in your real life?
I am going to stop checking my credit score app every single Friday morning.
That alone will probably lower your weekly stress level significantly.
It really will. I treat those small point drops like a personal failure.
That is the exact shame we want to get rid of today.
I need to accept that the number fluctuates normally based on my billing cycles.
That is the healthiest approach. We can build a simple listener action plan from this.
I would love a clear checklist to take away from this conversation.
The first step is to verify your oldest credit card is still active.
Just make sure it is completely open so that long reference letter stays intact.
The second step is to set up an automatic minimum payment on your daily card.
That builds the safety net so I never hit that 30-day late mark.
The third step is to check your actual credit report once a year for basic errors.
I am checking the report for administrative mistakes, not checking the score for my worth.
Exactly. 3 small steps that build a very boring, very safe credit history.
Boring really is the ultimate financial goal here. I never thought I would say that.
It is the absolute best way to live. Lenders love a boring track record.
I am officially aiming to be the most boring borrower in the country.
I love that. I have a question for anyone listening with us today.
I am very curious to hear the real answers to this one.
What is the most stressful credit myth you used to believe before today?
You can write a full story in the comments if you want to share it.
Or you can just leave one single word if that is easier for you right now.
Type the word utilization, inquiry, or closed if one of those traps caused you panic.
Seeing those words helps everyone realize they are not alone in this weird confusion.
It feels really good to finally walk away knowing how this game is actually played.
If you have a moment today, please drop one of those words in the comments for us.
It really helps to see that other people struggled with the exact same credit myths.
That shared honesty makes the financial system feel a lot less intimidating.
It definitely does. And do not forget to set up your automatic minimum payment today.
That small step protects your trust thermometer from the chaos of a busy week.
That safety net will save people from so much unnecessary stress next month.
It absolutely will. Your credit score does not define your personal worth or your success.
That is the best thing I learned during our entire conversation today.
It is simply a mathematical thermometer measuring how you handle borrowed money.
And we finally know how to read the temperature without panicking.
Exactly. You do not have to guess what the formula wants from you anymore.
You just focus on boring stability and let the score repair itself over time.
Thank you for sitting down with us today at Money Café America.
We will be here next time to untangle another stressful money problem together.
Until then, I'm Maya.
And I'm Ethan. A 3-digit number does not control your whole financial future.